Another thing that, I love this quote, another thing that successful active managers don't pay any attention to are forecasts, right? And it's really interesting to me because that's all we crave. I was on Twitter before I got here, and it was always, everyone is, so-and-so is saying that, fill in the blank. The market's going to collapse, the market's going to soar, this stock's going to do well, this stock's going to do poorly. Fact of the matter is they have zero effort at getting a correct forecast. Forecast, the old maxim was forecast early and forecast often, right? Because you're always going to probably get it really, really wrong. And what we do when we're looking at forecasts is we get sucked into the story of the forecast. And I even find myself, like I was on CNBC one day and this guy, he had a great story, right? And he's like, well, we've looked at 110 different variables and we ran a correlation matrix about how these variables have done in the past, and I'm very confident to be able to tell you that sometime this week the market is going to go down by 10%. And I really had to kind of, leave, go to the green room, throw water in my face, and okay. He has no idea what he's talking about. And yet we love it, right? Because we crave narrative. We want to know the future, right? And I joked the other day that I will predict that in the future, people in the future will think they can forecast the future. And Cicero, a Greek philosopher and statesman who didn't end well, had a great quote that went along the lines of, it doesn't matter how learned you are or how base, all of us believe that we can forecast the future, and we can't. And it would be great, and if I could forecast the future, I can promise you I would not be standing here giving this talk to Google. I would be on my own private island, having flown there in a G5, because I would have done just great. And the fact is, though, it is our very human nature that makes us want to be able to make those types of forecasts. Here's a forecast. This is kind of interesting. So CXO is a site that is dedicated to what we do, investing. And over a long period of time, they gathered 6,582 forecasts. And down here are the results. So basically, now remember, these weren't people they pulled off the street, right? Hey, what do you think the Dow's going to do? Actually, there's a thing called the wisdom of crowds that say you might do better if you pulled enough people off the street. That's a different story. Anyway, these experts, 42 of these experts had efficacy ratings below 50%. What does that tell us? We get a room full of monkeys, we give them quarters, we have them flip those quarters, and we're going to do better on our forecast than these so-called vaunted experts. I mean, let that sink in. And again, we can't help ourselves. There's this thing called the halo effect. The halo effect is, well, you guys all have the halo effect. You work at Google. I mean, how cool is that? And so what happens is, oh, you work at Google? Immediately, that person begins to attribute to you all sorts of things that many of you don't deserve, right? It's like, yeah, I work at Google. How you doing? And suddenly, that other person who's meeting you for the first time is enraptured. Wow, you're smart, you're good looking, you work at Google. Oh my God, this guy is amazing. Happens in what I do, it happens everywhere, right? The minute you get published in a prestigious journal or the minute you come up with a great algorithm, you get other attributes assigned to you that you don't deserve, as the cold hard facts basically point out. And so it's not just this, by the way. So they used to do surveys until they got so embarrassed by them that they stopped doing them. And these were surveys of institutional investors, and they did them once a year because they had a big gathering in New York City. What's your favorite stock for the year? Well, if you know, Jim Chanos, who's very famous for shorting stocks, I gotta bet that he was simply there writing them down and then running out and shorting them. 1999, guess what their favorite stock was? Enron. They loved Enron. And for those of you unfamiliar with Enron, it was the largest bankruptcy in US history at the time. They were lying to everybody. And again, showing the importance of narrative. I talked to a fund manager who owned Enron, and he was telling me he was buying more. And I'm like, dude, you know, we showed him the quant screens, and it's like, this is not a stock you want to buy. It's in the worst category on financial strength. It's in the worst category on value. It's in the worst, essentially, it's like the worst stock. And he's like, no, Jim, you don't get it. I got invited to a barbecue at the CFO's house of Enron. The CEO was there, the chief legal counsel was there, everybody was there. And they gave me a beer and we started talking, and they assured me that their stock was going to double from these levels. And I'm like, okay, probably a really good thing you didn't go to a barbecue at Bernie Madoff's house, because he probably would have even given you much better assurances as to the efficacy of his particular take. And yet again, we're coming back to the theme here, which is, guess who sits right at the center of all our screw-ups? Us. It is human nature to do all of these things, because a lot of shortcuts work. A lot of them don't, right? So recency bias doesn't work when you're trying to think long-term. Availability bias doesn't, it narrows you down to thinking about just what you can remember. You know, overconfidence bias, I'm sure that many in the room have that. I certainly do. Overconfidence bias is, hey, I'm a stud. I know how to pick stocks. This is great. No, I'm not. And the fact is, I make as many mistakes if I'm trying to do it without the guidance of base rates and all of the things that we've been talking about as anyone else. And so in terms of predictions, the last story I'll tell, which I love. So Fortune magazine, in its wisdom, decided to do a cover story in the summer of 2000. And the title of the story was 10 Stocks for the Next Decade. And they hyped it, and they, you know, these are going to be the best stocks. Buy these 10 stocks. Don't even look at your portfolio over the next 10 years. You're going to be delighted. Well, for people who actually didn't look at their portfolio, it did probably save them from killing themselves, because of the 10, 2 went bankrupt. Enron, we've already mentioned, and Nortel, a big Canadian name. And the balance of return for these 10 stocks was minus 27% overall versus a gain of 116% for the S&P 500. Right? Why? Because they got caught up, they loved the story, and they just couldn't bring themselves to think not in terms of stories, but in terms of what's going on right then and there.